On February 3, 2026, Cirrus Aircraft introduced the G3 Vision Jet. Deliveries were already underway. General aviation media covered it as what it was: a cabin and software refresh with more than 30 refinements on the same airframe, same Williams turbofan, same ceiling and range. The best-selling jet in its segment didn't need a redesign. Record deliveries, no direct competitor, a roughly 9-month backlog, and a $3.68 million equipped price said the math was working. 4 months later, the U.S. Department of Defense designated Cirrus Design Corporation as a Chinese military company. To understand what that means for the most successful personal jet ever built, start with what Cirrus actually changed. The February 3, 2026 announcement of the G3 Vision Jet marked a deliberate progression for Cirrus Aircraft, an established American manufacturer. Rather than presenting a clean-sheet redesign, the company introduced the third generation of the SF-50 family as an evolutionary update, with customer deliveries already underway at the time of the public release. Industry media characterized the G3 as a targeted cabin and software refresh, incorporating more than 30 refinements across the cabin, software, and overall usability. This product strategy reflects a calculated balance between visible refinement and underlying technical continuity. The carbon fiber airframe, the Williams FJ33-5A turbofan engine, and the performance envelope remain identical to preceding models. By maintaining the established physical platform while upgrading the passenger space and flight deck avionics, Cirrus avoided the capital expenditures and certification timelines associated with an entirely new aircraft design. This approach allowed the company to satisfy backlog demand without halting active assembly lines in Minnesota and North Dakota. Because the company faced no direct competitive pressure, avoiding the development costs of a clean-sheet airframe was a highly practical business decision. The objective was to preserve the market dominance of the SF-50, making the G3 a rational update to an already profitable product line. The internal and avionics modifications of the G3 represent concrete, customer-facing developments. Inside the cabin, the primary engineering adjustment centers on passenger configuration and usability. The redesigned cabin features a modular second and third row layout, replacing the older 5-adult and 2-child arrangement. This new design introduces a third row bench seat configured to accommodate 6 adults and 1 child, maintaining the maximum seating capacity of 7 occupants while shifting the cabin utility toward adult passengers. The individual seats are built with Alcantara-wrapped hardshell seat backs and designed for single-hand adjustment. A quick-release lever system allows operators to remove or install the middle seats easily to alter cargo capacity. Aesthetic choices are expanded through updated Arrivee design schemes, matching the cabin finishes directly with the SR series piston aircraft. On the flight deck, the G3 integrates the Garmin Perspective Touch Plus suite, a derivative of the Garmin G3000 Prime architecture. This interface introduces several workflow automation tools to reduce pilot workload. A key addition is the ATC data link, which utilizes a GDR66 radio to enable controller-pilot data link communications. This system receives text-based air traffic control clearances and digital reroutes, which the pilot can load directly into the avionics with a single push-to-load command. Flight deck data management is updated through Cirrus YQ Pro Advanced, which automates navigation database updates using a built-in cellular connection via the Garmin GDL60 transceiver, keeping navigation systems current without physical card transfers. Additional software modifications target pilot workload during ground operations and abnormal flight conditions. The avionics suite employs alerts-linked electronic checklists that automatically display relevant procedures when the crew alerting system detects an abnormality. Ground movement safety is managed through the integration of 3D Safe Taxi and Progressive Taxi routing, which render real-time, step-by-step guidance on airport taxiways to prevent runway incursions. Exterior modifications focus on night operations. The G3 utilizes the Spectra wingtip and landing light package, which integrates forward-looking light-emitting diodes and a halo of wingtip illumination. This array increases total illumination to 2.7 times the output of legacy systems, expanding the forward and lateral visual field during taxiing, takeoff, and landing. Collectively, these systems modify the operational experience of the SF-50 without altering the physical dynamics or performance limits of the airframe. Evaluating the G3 through its primary performance parameters reveals how heavily the update relies on the platform's original certification baseline. The power plant remains the Williams International FJ33-5A turbofan, generating 1,846 pounds of thrust. This is the exact engine integrated during the initial 2016 certification of the SF-50, operating without mechanical modifications or internal power management changes. By maintaining this mature engine configuration, the design benefits from an established reliability profile and a predictable cost structure, prioritizing maintenance predictability over power output adjustments. The aircraft's performance limits remain similarly constant. The service ceiling is capped at flight level 310 or 31,000 feet, a limit established during the G2 RVSM certification. Operating range is retained at 1,275 nautical miles. This range is achieved using the same fuel capacity as previous generations, with no structural tank modifications or range extension programs introduced. The only measurable performance variance is a minor adjustment in velocity. Maximum cruise speed rises from 311 knots, true airspeed, to 317 knots, true airspeed, yielding a gain of 6 knots. On the flight deck, the avionics architecture remains grounded in the legacy system. Despite anticipation among some prospective buyers for an integration of Garmin's newest G3000 Prime suite, the G3 continues to utilize the Garmin-based Perspective Touch Plus platform. While this interface features updated software and subsystem communication protocols, it does not represent the physical hardware transition to a true G3000 Prime flight deck. Consequently, retrofits or component transitions remain bounded by the physical dimensions and wiring constraints of the existing instrument panel architecture. These technical specifications position the G3 not as a clean sheet redesign, but as a cabin and software release built directly onto a 2016 airframe and 2016 power plant. For operators and market analysts, this continuity highlights a deliberate corporate choice. By retaining the fundamental aerodynamics, propulsion, and structural limits of the original design, the manufacturer avoids the capital-intensive and prolonged certification processes required for a new type certificate. This approach preserves assembly line continuity while focusing the commercial appeal entirely on digital and interior refinements, allowing the existing manufacturing infrastructure to maintain its cadence without interruption. For a prospective buyer, evaluating the third-generation Vision Jet involves a direct economic calculation. The base model is priced at roughly $3.6 million, while a typical as-equipped configuration reaches $3.68 million. When compared to the last published equipped price of $3.25 million for the G2 Plus, the new model carries a premium of roughly 13%. This price difference covers the cost of specific cabin and software updates rather than a performance-driven redesign. Buyers pay for the modular interior configuration, the Perspective Touch plus avionics features, the Spectra lighting package, and the modest 6-knot cruise speed improvement. Despite this premium, the commercial pipeline shows steady market demand. The Vision Jet order backlog currently runs at about 9 months, showing that operators are willing to commit capital to the established platform. This strong order book validates the manufacturer's decision to prioritize targeted refinement over capital-intensive development. By introducing these changes, Cirrus captures a higher margin per airframe while avoiding the production interruptions that a brand new aircraft program would introduce. In an environment with minimal direct competition, paying this premium for targeted upgrades remains a practical choice for owners. For the buyer, the transaction is a predictable investment in modern cabin comfort and flight deck systems on an already proven airframe. During 2025, Cirrus Aircraft delivered 106 Vision Jets, establishing a new annual record for the single-engine program. This performance secured the aircraft's position as the most delivered business jet in the world for the 6th consecutive year, outpacing every twin-engine competitor in the light jet segment. For comparison, Embraer delivered 66 Phenom 300E units in 2025, which is a twin-engine model, while Honda Aircraft delivered 11 Honda jets in 2024. Since December 2016, 721 Vision jets have reportedly been delivered, establishing a massive fleet footprint for a single-engine design. This single-engine success occurred alongside the delivery of 691 SR series piston aircraft in 2025. These combined product lines allowed the manufacturer to capture a significant share of the general aviation sector. Globally, business jet shipments rose to 854 aircraft in 2025, representing an 11.8% increase over the previous year, while total industry airplane billings reached $31.0 billion. The General Aviation Manufacturers Association reported 3,230 total airplane deliveries in 2025, which represents a 2.2% increase over the previous year. Within this context, the combined output of the Duluth, Minnesota, and Grand Forks, North Dakota, assembly lines represents a substantial portion of global general aviation manufacturing. Within this growing market, the Vision Jet occupies an uncontested commercial position. It faces no direct competitor in the specific single-engine personal jet category. Developing a clean sheet aircraft requires substantial capital, carries regulatory certification risks, and threatens to disrupt active production. Because demand remains high and no rival product exists to challenge its market share, the manufacturer had no commercial pressure to pursue an expensive ground-up redesign. The operating record shows that incremental investment in cabin and software refinements was the most rational business path. The massive order pipeline and dominant segment status suggests that a complete airframe redesign would carry unnecessary execution risk without clear financial benefits. By modernizing the existing platform, the company maintained its production velocity at facilities in Minnesota and North Dakota, securing highly profitable margins while continuing to dominate the light turbine segment. This approach allowed the builder to capture higher margins per airframe and avoid the production interruptions that an entirely new aircraft program would introduce. In 2011, China Aviation Industry General Aircraft, commonly referred to as CAIGA, acquired Cirrus Aircraft for approximately $210 million. CAIGA operates as a direct subsidiary of the Aviation Industry Corporation of China, or AVIC, placing the Duluth-based aircraft manufacturer within a state-owned corporate hierarchy. At the time of the sale, the transaction underwent review by the Committee on Foreign Investment in the United States, the government committee that evaluated foreign acquisitions on national security grounds, which cleared the transaction to proceed. Under this structure, ultimate corporate control flows directly to Beijing through AVIC. In 2021, the United States government placed AVIC on an investment blacklist, restricting domestic investors from purchasing its debt or equity securities. This foreign capital structure remains distinct from the physical manufacturing origin of the aircraft. For pilots, owners, and aviation professionals, separating financial control from the assembly line is essential to understanding the company's real-world status. The Vision Jet is designed and assembled at the company's primary facility in Duluth, Minnesota, while its carbon fiber composite components are manufactured in Grand Forks, North Dakota. The physical manufacturing process remains entirely domestic, employing hundreds of aerospace workers in the American Midwest. The aircraft are American-built machines, even as their parent organization remains closely tied to the defense industrial base of the Chinese state. A minority stake in the parent entity began trading on the Hong Kong Stock Exchange on July 12, 2024, under ticker symbol 2057HK. The initial public offering, priced at 27 Hong Kong dollars and 50 cents per share, raised roughly $197 million and was recorded as the second largest Hong Kong listing of that year. Public market reception remained cautious, and by September 2024, the share price had declined, trading more than 30% below its initial listing level. This early equity performance stood separate from the operational execution of the manufacturing facilities in the United States. On the 3rd of July 2025, AVIC executed a secondary market transaction, selling 17.5 million shares of the company at a price of 39 Hong Kong dollars and 98 cents per share. This transaction represented approximately 4.78% of the total outstanding equity and generated roughly 700 million Hong Kong dollars. Through this block trade, AVIC reduced its controlling ownership stake from 84.97% to 80.18%, maintaining a dominant majority of the voting rights while securing liquid capital in the public market. The reporting requirements of the public listing provided regular disclosures of the company's underlying financial position. The audited reports revealed significant growth in core business activities, distinguishing top-line performance from net margins. In 2024, the company generated revenue of $1.2 billion, representing a 12% increase over the previous year. Net profit for 2024 rose to about $120 million, a 32.5% growth rate. This trajectory continued into the next fiscal period, with the company expanding its balance sheet. In 2025, reported revenue reached $1.35 billion, marking an increase of 13.1%, while net earnings rose to $138.9 million, reflecting a 15.0% year-over-year improvement. While these figures demonstrate strong commercial demand and expanding operational profitability, public market valuation models applied a distinct discount. In mid-2025, the stock traded at a valuation multiple of around 16 times earnings. During the same period, Textron, the parent corporation of Cessna and a primary competitor in the broader business aviation market, traded at approximately 19 times earnings. This valuation discount was not driven by product performance or delivery backlogs. Instead, equity analysts framed the lower valuation multiple as a direct reflection of ownership risk. Public market investors factored the geopolitical exposure, regulatory scrutiny, and state-linked parent organization into the share price, establishing a persistent gap between the company's industrial success and its capital market valuation. On June 8, 2026, the United States Department of Defense published its updated statutory list of Chinese military companies operating in the United States, compiled in accordance with Section 1260H of the National Defense Authorization Act. This update marked the largest expansion of the Section 1260H list since its inception, adding multiple foreign-owned entities active across the domestic commercial sector. Among the newly listed entities was Cirrus Design Corporation, the legal operating entity of Cirrus Aircraft, which was placed under its ultimate parent company, the Aviation Industry Corporation of China, or AVIC. This federal action systematically documented foreign ownership ties across the American light aircraft industry. The designation was part of a broader administrative action targeting several United States-based general aviation and aerospace manufacturing firms within the same corporate network. Alongside Cirrus, the Department of Defense added Align Aerospace and Continental Aerospace Technologies, both of which operate under the AVIC corporate umbrella. This joint inclusion highlighted a systematic federal mapping of AVIC's industrial holdings within the American market, bringing major domestic general aviation suppliers into the regulatory spotlight. In its official publication, the Department of Defense described AVIC as a state-owned enterprise directly controlled by China's State-Owned Assets Supervision and Administration Commission, or SASAC. The Pentagon identifies AVIC as a direct contributor to China's military-civil fusion strategy, which coordinates civilian-industrial development with defense modernization goals. This policy framework seeks to prevent the transfer of dual-use technology from civilian manufacturing sectors into state military programs. The inclusion of Cirrus on the Section 1260H list was registered as a corporate affiliation decision rather than a technical finding regarding the company's civilian aircraft. The Department of Defense provided no separate explanation or specific allegations directed at Cirrus Design Corporation's operations, engineering, or product lines. Instead, the listing rested entirely on the parent-subsidiary relationship, mapping Cirrus's position within the state-owned corporate hierarchy that flows through CAIGA to AVIC. By placing the manufacturer on the roster, federal authorities registered the commercial general aviation asset within the broader strategic framework of foreign state-directed aerospace entities operating within United States borders. The practical legal consequences of the Department of Defense designation are defined under Section 805 of the fiscal year 2024 National Defense Authorization Act. This federal statute establishes clear limits and timelines for government procurement, separating direct military contracts from indirect commercial transactions. The first restriction took effect on the 30th of June, 2026, prohibiting the Pentagon from entering into direct contracts with Cirrus Design Corporation. This initial ban became active exactly 3 weeks after the 8th of June, 2026 listing was published. The second restriction, which bans indirect procurement of end products containing components supplied by the listed entity, does not take effect until the 30th of June, 2027. These statutory limitations are not absolute. The Secretary of Defense retains the authority to issue a temporary national security waiver to bypass these rules, provided the department presents a formal justification to Congress. Beyond these military procurement rules, the Section 1260H designation carries no automatic economic sanctions. The legal scope of Section 805 is limited entirely to Defense Department procurement and does not apply to the private general aviation market. There is no ban on the civilian sale of Cirrus Aircraft in the United States. There is no ban on civilian ownership of these aircraft, and there is no ban on civilian flight operations. Private operators, corporate flight departments, and commercial flight schools remain free to buy, own, and fly these aircraft. The regulatory status of these American-built aircraft, assembled by workers in Duluth, Minnesota, and Grand Forks, North Dakota, under Federal Aviation Administration rules, is completely unchanged, meaning civilian operators can continue normal flight activities without legal or operational restrictions. On July 15, 2025, Utah Governor Spencer Cox announced that the state had blocked an attempted land purchase by Cirrus Aircraft near Provo Airport. The transaction was stopped under a state law restricting acquisitions by foreign entities, with officials specifically citing Cirrus's parent company, AVIC. The proposed deal was worth millions of dollars and would have created hundreds of jobs, representing a direct clash between regional economic growth and foreign ownership scrutiny. Another shift occurred on June 8, 2026, the publication date of the Section 1260H list. Arcline Investment Management announced a $535 million acquisition of Continental Aerospace Technologies, which was also owned by CAIGA. The Continental transaction established a precedent that invites discussion regarding a potential AVIC divestiture of Cirrus, though no Cirrus divestiture has been announced. Instead, the immediate impact of the designation is observed through speculative market pressures. Financial analysts expect potential commercial headwinds to manifest in future financing terms, corporate partnerships, and secondary market resale sentiment. For now, these commercial pressures remain analyst expectations rather than observed delivery outcomes, as the civilian market for these American-built aircraft remains free of direct federal bans. The incremental modifications of the G3 represent a rational product decision for a manufacturer dominant in its category. Supported by an established 9-month backlog and record annual deliveries, Cirrus had no commercial incentive to accept clean sheet development risks. However, general aviation coverage in 26 underweighted the corporate ownership structure, focusing instead on the lack of radical airframe changes. This ownership reality creates a concrete tension. American aerospace workers in Minnesota and North Dakota build the best-selling light jet in the world, while the underlying corporate control remains with the Chinese state. Whether this aircraft continues to outsell every competitor, while its state-linked owner becomes an unresolved commercial liability, remains the open question for the industry. Today, American workers in Duluth and Grand Forks continue to build the world's best-selling personal jet. Yet, the Section 1260H designation ensures its Chinese state ownership remains under intense federal scrutiny. As geopolitical lines harden, the ultimate test for Cirrus will not be engineering, but whether its state-linked parentage eventually overrides its market dominance. Whether this aircraft continues to outsell competitors while its owner becomes a commercial liability remains the industry's unresolved question. Share your perspective in the comments below.